$7.77389 trillion. That's how much is sitting inside U.S. money market funds as of the week ending February 11th, 2026. Not in stocks, not in real estate, not in private deals, in cash-like instruments that reset daily, waiting for the next instruction. And here's the part that breaks expectations. This mountain of cash is not calm money, it's compressed energy. 70, that means the world is being paid right now to wait. That's already deployed. That's already positioned. Those two realities can coexist for a moment, but they cannot coexist forever. And this is happening fast, not months, not weeks. In 48 hours, cash can move from a bank deposit to a money market fund, then into a treasury bill, then into an ETF, and then into whatever the next narrative says is safe or hot. The old idea that money changes direction slowly is obsolete. The plumbing is digital, the vehicles are liquid, and the competition is brutal. They said a world like this could never happen. They said cash was boring. They said cash was the sidelines. But when the cash pile gets big enough, the sidelines become the whole stadium. And when institutions know how to move it, they don't just respond to headlines, they create the next headline. Because smart money isn't leaving cash in the way most people imagine. It's leaving idle cash. It's leaving exposed cash. It's leaving the kind of cash that earns nothing and can be trapped by a single policy shift. And it's flowing into instruments that can flip from safety to risk with a few clicks, with billions moving before most people even notice the price. Welcome to Roki Studio, where we decode what matters before its headlines. The goal here is simple. Follow the data, map the incentives, and understand the moves that happen in the background. If you like analysis that feels like sitting with a calm, experienced observer who reads the room before the room knows it's changing, you'll feel at home here. And as you listen, drop a comment with where you're watching from. Because this is a global story playing out in real time. Now let's get forensic. 77389 trillion in money market funds. That is not a normal figure. That is a gravity well. It's larger than the GDP of many major economies. And it's parked in products that were designed to be temporary. Money market funds exist to hold cash and near cash, to provide stability and daily liquidity. But when the pile gets this large, the fund industry becomes a major buyer of short-term government paper and high-quality short-term credit. In other words, the cash has a footprint. Now layer in the banking system. 647 trillion on January 28th, 2026. Deposits are the raw material of lending. They are also the raw material of bank balance sheets. When deposits migrate, it changes the cost of funding for banks, and it changes how much credit can be created or withdrawn. This is where the crisis begins, because cash leaving traditional deposits for money market funds is not just a preference. It's a structural shift in who holds the steering wheel of liquidity. The central mystery is this. If cash is so abundant, why do the people paid to manage billions report historically low cash buffers? 3% cash? They're not bracing. They're not hiding. They're committed. Yet the public narrative still talks like everyone is waiting for the perfect entry or the perfect signal. Those stories can't both be true. So the question becomes, who is actually holding the cash and what is it waiting for? Here's where it gets interesting. Money market fund cash is often corporate cash, institutional cash, and household cash that has become rate sensitive. It's not always speculative. It's often transactional. But the moment rates become meaningful again, parking turns into strategy. People stop leaving money in places that pay nothing. They start demanding yield. And yield in the modern market is not just income, it's optionality. It's the ability to wait without bleeding. That is why the T-bill yield matters so much. 69% is not a stock rally, but it's not zero. It's a signal that short-term money has power again. It gives cash a reason to exist without shame. And when cash has power, it becomes the hinge between risk on and risk off. It becomes the lever that can amplify movements in other asset classes. Now look at the flow evidence. In January 2026, US ETFs took in roughly $156 billion in net inflows. That is a flood. That is capital choosing the most liquid, most efficient on-ramp to exposure. ETFs are not just a retail tool anymore. They are a pipeline. They are how institutions can shift exposure quickly, hedge quickly, and rotate quickly. If you want to see where money is going, you watch the pipelines, not the headlines. So we have three simultaneous facts. 77389 trillion. 3%. 3. ETFs are absorbing huge inflows, around $156 billion in a single month. That combination is not stable. It is a setup. It tells us the market is not frozen. It is repositioning. To understand what comes next, you have to understand the pattern, because this is not the first time the surface story and the underlying positioning have disagreed. In 2000, the surface story was unstoppable growth. The pattern underneath was concentration, leverage in sentiment, and a belief that liquidity would always be there. When the belief broke, money didn't vanish. It rushed into perceived safety, and the repricing was violent. In 2007, the surface story was that risk was diversified and contained. Underneath was a funding system built on short-term confidence. When confidence cracked, cash didn't just become king, it became scarce in the places that needed it most. And in 2020, when stress arrived suddenly, markets revealed how quickly liquidity can shift from a feeling into a constraint. These moments share a playbook. First, cash clusters. Then, cash gets priced. Then the instruments that hold cash become engines of movement. Finally, the market reprices whichever asset class was mispriced relative to that cash reality. And in 2026, the pieces are arranged in a way that resembles the early stage of that playbook. Let's name the players, because smart money is not a person. It's a set of institutions with different incentives, moving through specific channels. First are the money market funds themselves. These funds are gigantic buyers of treasury bills and other short-term instruments. When assets swell, the demand for short-term paper swells, and that affects the short end of the curve. Second are the treasury auctions and the dealers who intermediate them. The treasury issues bills on a schedule. Dealers make markets. Money funds buy. Rates adjust. Third are the banks, who compete for deposits and manage liquidity rules. When deposits leave, banks either pay up, change balance sheet strategy, or tighten credit. Fourth are the asset managers and hedge funds, who deploy through futures and ETFs because they need speed and precision. And fifth are the policymakers and central bank facilities that influence the price of overnight money, even when the public is focused on stock charts. None of these players needs a conspiracy to create a coordinated outcome. They just need aligned incentives and synchronized timing. And timing is visible in the data. When T-bills offer meaningful yield, idle cash migrates. When deposits migrate, banks adjust. When banks adjust, credit conditions shift. When credit conditions shift, asset prices that depend on easy credit start to wobble. And when wobble appears, institutions already deployed with low cash buffers have to hedge, rotate, or reduce risk, not because they panic, but because their risk models tell them to. That's the machine. And it's already running. Now for the dislocation, the part no one is discussing with enough clarity. But the real dislocation is between the location of cash and the control of cash. The cash is in vehicles designed for speed, and the control of that cash is concentrated in institutions that know how to deploy it instantly. A money market fund share is like a staging area. It can become a treasury bill purchase. It can become a sweep into a repo facility. It can become collateral for another trade. It can be pulled and pushed between institutions with almost no friction. It is actively being positioned for optionality. Meanwhile, low cash buffers and risk portfolios mean the risk side of portfolios is already crowded. If cash buffers are thin, managers cannot simply buy the dip with spare cash. They have to sell something else to raise liquidity. That is how volatility amplifies. Not because of fear, but because of mechanics. This is why the ETF inflow number matters so much. $156 billion in January 2026 is not just a statistic. It is evidence of a preference for liquid exposure. Liquidity is not a moral concept. It is a survival concept. When markets move, the assets that can be traded become the assets that carry the adjustment. ETFs concentrate that behavior. They allow rapid rotation, but they also concentrate flows into the same instruments. So you get a situation where cash is huge, but it is not in the form of unused buying power sitting in brokerage accounts. It is in the form of institutional liquidity that can be turned into risk exposure or withdrawn into safety instantly. That is a very different kind of cash. Let's put more numbers on the table because this is not opinion, it's pattern. 77389 trillion in money market funds as of February 11th, 2026, 647 trillion in US commercial bank deposits as of January 28th, 2026, 70%, 3%. ETFs absorbing around $156 billion in net inflows in January 2026. These figures describe an economy where short-term money has been repriced upward, where deposit behavior is rate sensitive, where professional portfolios are already leaning into exposure, and where the preferred vehicle for moving fast is the ETF wrapper. Now ask, where is smart money going if it is leaving cash? It's going into three broad destinations, all of which look like cash from far away, but behave differently under stress. The first destination is short-duration government exposure. They are the baseline alternative to idle deposits. When yields are meaningful, this becomes the default choice for cash that cannot tolerate volatility. The second destination is cash plus, the slightly riskier space of high-quality short-term credit, repos, and strategies designed to pick up incremental yield. This is where the line between cash and risk starts to blur. A small spread can look attractive until liquidity tightens, and then that spread reveals its cost. The third destination is liquid risk exposure through ETFs and futures. because institutions like speed, they like flexibility. And if they believe a certain part of the market is mispriced, they can express it with a tool that is designed for rapid entry and rapid exit. These destinations aren't mutually exclusive. The point is that cash is being reorganized into structures that maximize optionality. There's another layer that makes this moment unique. The modern cash ecosystem is built around daily liquidity promises. Money market funds offer same-day or next-day access. Treasury bill ETFs trade all day. Overnight repo markets can convert collateral into cash with incredible speed. And the faster these channels become, the more they behave like a single connected organism. A shift in one corner can ripple across the rest in hours. This is why you can't simply look at a headline that says cash is at record levels and conclude that markets are safe. High cash levels can mean caution, but they can also mean ammunition. The key is whether that ammunition is already assigned a target. Low cash buffers among managers imply that many targets have already been chosen. That creates a fragile equilibrium. Confidence feels high because positions are on, but resilience is low because the spare capacity to absorb shocks is thin. You can see echoes of this in periods that were famous for funding stress rather than earning stress. In 2013, a shift in expectations forced a rapid repricing in rates. In 2018, tighter liquidity late in the year triggered sharp moves across risk assets. And in early 2020, market plumbing became the story before the economic data even had time to update. The lesson from those episodes is simple. The most important risk isn't always the headline risk, it's the funding risk. It's the moment when everyone realizes that the easiest source of liquidity has changed price or changed availability. When that happens, people don't rewrite their narratives. They adjust their positions, and the adjustment becomes the event. This is also where expert contradictions appear. Both can be right because they are describing different pools of money with different mandates. So the question isn't whether cash exists. Cash always exists. The question is whether cash is patient. 69% makes cash more patient. 70 makes cash more reactive because the roll schedule is constant. Every week, massive amounts mature and must be reinvested. That reinvestment is a recurring decision point. It is a recurring referendum on what the system prefers, safety, yield, or risk. And here's the subtle part. When money funds get very large, they become central to short-term funding markets. In quiet times, that seems technical. In stressed times, it becomes a spotlight because everyone is looking at the same pool of liquidity, hoping it will provide stability, while also knowing it can move away instantly if the incentives change. It is stable until it isn't. It is abundant until it becomes scarce in the specific place that needs it most. It is boring until it becomes the catalyst for the next repricing. Now let me show you the mechanism, the how, without drowning in jargon. Think of the financial system like a city with different kinds of parking. Bank deposits are like street parking, convenient, familiar, but subject to local rules and scarcity. Money market funds are like a large, well-lit parking garage next to the highway. You can enter and exit quickly, and you can connect to bigger roads. Treasury bills are like reserved parking with a guaranteed rate. You pay for time, you know what you get, and you're confident you can leave with minimal friction. When the city raises the cost of street parking, or when the garage offers a better deal, cars move. In finance, that better deal is yield. 69% for 13 weeks, and money market funds translate that into a competitive yield. Cash leaves street parking. Deposits migrate. The bank has to respond. It might offer higher rates to keep deposits, which squeezes its margins. Or it might shrink its loan book. Or it might seek alternative funding that is more expensive and more sensitive to market conditions. Each of those responses tightens conditions somewhere. Not always immediately, but eventually. Now combine that with low cash buffers and risk portfolios. If a shock hits, maybe rates move, maybe credit spreads widen, maybe an unexpected economic print. Changes expectations. Managers who are already deployed have to rebalance. If they can't use cash, they sell liquid holdings. What is liquid? Often the very ETFs and index exposures that absorbed inflows on the way up. This is why dislocations become self-reinforcing. Liquidity creates speed. Speed creates forced decisions. Forced decisions create volatility. So what does the data suggest going forward if these trends continue? Historically, when you see record-like piles of cash and yield vehicles alongside aggressive deployment in risk assets, you are in a regime where markets can swing between two narratives quickly. In a conservative scenario, the cash pile stays large, T-bill yields remain competitive, and markets grind with periodic sharp rotations as data surprises hit. In a moderate scenario, deposit competition intensifies, credit conditions tighten, and you see volatility spikes as leveraged and crowded exposures are trimmed. In a more aggressive scenario, a policy or funding shock forces a rapid unwind, and the very vehicles that made risk exposure easy become the channels through which exposure is reduced. Notice what's missing there: a guarantee. This is not about certainty. It's about conditional probability. It's about recognizing that the system is primed for faster moves because the cash is organized for speed, and the risk side is organized for full deployment. So what do you watch? Watch the short end of the curve. When the 4-week and 13-week bill rates move meaningfully, it changes the incentive to hold deposits versus bills. Watch the size of money market fund assets because the pile itself is a signal of how much optional liquidity exists. Watch deposit trends because deposits are the lifeblood of bank credit creation. Watch ETF flow data because it reveals where exposure is being added or reduced in real time. And watch any signs that professional cash buffers are rising because that tells you the system is rebuilding shock absorbers rather than chasing returns. Now the final piece, the divide, the part that explains why this matters to anyone listening. There are always two groups in markets. The first group watches prices and stories. The second group watches flows and constraints. The first group hears cash on the sidelines and assumes it will support markets. The second group asks, what kind of cash? Where is it held? How fast can it move? Who controls it? The wealth gap in markets is often an information gap. Not secret information, but interpreted information. Institutions don't need to know the future. They just need to know the mechanics. 7.389 trillion are not passive. 69% changes behavior. 647 trillion are not guaranteed to stay put. They understand that $156 billion in ETF inflows means exposure can be both built and removed quickly. That's why smart money isn't leaving cash in a dramatic, cinematic way. It's leaving the wrong kind of cash. It's moving into cash that earns, cash that can be mobilized, and cash that can become collateral. And at the same time, it's keeping risk exposure liquid enough to rotate when the story flips. If you want a single mental model, imagine a crowd standing at a set of doors that can open in either direction. 77 trillion cash pile. The doors are yields, credit conditions, and volatility. When the doors swing toward safety, cash crowds in and risk thins out. When they swing toward opportunity, cash surges through and prices jump suddenly. This is the part no one is discussing. The next major move in markets often isn't a single event. It's a liquidity choice, a migration, a repricing of what it means to wait and what it costs to be wrong. If this connected dots you hadn't seen, you know what to do. This is Roki Studio, where we decode what matters before its headlines. And the question isn't whether the cash pile moves. The question is whether you'll recognize the signals before the movement becomes the story everyone pretends they saw coming.